Another great welcome from Randy and Venkat. Guys, depreciation. What's the first thing comes to your mind? What's the first thing? For me, I mean, I've studied a little bit of accounting, so the first thing comes to my mind when someone talks about depreciation or someone uses the word depreciation is it's an expense, right? Oh my God, depreciation. So I have to, I'm losing money and it's going to go down the drain and it's going to be a zero value after 5 years, whatever, right? But the funny thing or here's the best part though. We're going to talk about depreciation, but how depreciation can be used for your advantage if you're a real estate investor. So without further ado, Venkat, I want you to walk us through that. I'm so interested because, like I said, the moment someone talks about or moment someone uses the word depreciation, all I get is this anxiety. Oh my God, I'm gonna lose money, but it's not always the case.
Right, that's right. Yeah. So like real estate, we know that the value appreciates, right? The
Right,
value, but not the building itself. Like building is deteriorating
right,
like day by day. It's not the normally like 100 years. It's I think that the buildings that are built today, these days, guys, it's 100 years it
yeah,
can withstand. So that is what they give you, right? So 100 years means it's not going to be good. 100th year probably everything shaky,
right,
right? So if you still live through that, you can probably test it out. But that is called depreciation. It's depreciating on the quality, right? That is what the IRS is giving you opportunity to take that some advantage for you, tax advantage. Like you bought a real estate is the biggest investment in your portfolio, and you have option to take that depreciation. A lot of people misses it. A lot of people don't even know it.
right,
That's like throwing money in the in your in the toilet, right? So
right.
basically you're flushing the money out. There's thousands of dollar, guys. So let's take an example. You have a rental property, couple of rental properties, and the value, just to make it easier, 20 $275,000, guys. So the property, not including the land never depreciates, right? Land is always going to be there
Yeah,
unless you have earthquake or something. It's still going
right,
to be there.
right,
That land is not going to break it, right? So you have to remove the land value. That is important thing.
right.
And then take the building value. Let's say building value is $275,000,
Mhm.
your building value, right? So divide that by 27 and off, because they're giving you 27 and off years to take the depreciation.
Okay, okay.
Uh, so you bought the property, like let's say last year, one of the
Mhm.
properties $275,000, the property value, not including the land. You
Yeah,
divide that by 27 and a half, you get $10,000, right?
right.
So $10,000 every year you can take in your tax return. So keep on taking $10,000. Let's say you're making $20,000 rental income on that, right? twenty
Mm,
thousand dollar is the income on the property. So you remove $10,000 right away. It
okay,
removes $10,000 right away, right? And then
right,
you would have, yeah, you have to pay expenses. You have to operating expenses,
right,
non-operating
right,
expenses. If you
right.
remove everything, like you don't need to pay any taxes on that property.
Let me
You
get this straight, Venkat. You said 27th. So let's say if I'm renting, let's say if I'm renting a property for $2,000 per month, right?
Mhm.
And by the end of the year, let's say 24,000,
Right.
gross income 24,000, and of that 20, and I'm taking that example that you took, 275,000 is the property value. So I mean, the property in the sense the building value.
Right.
So divided by 27 and a half, that's 27,000. Uh,
That's 10,000.
sorry, 10,000. Sorry, 10,000. 10,000. And if my yearly rental income is 24 grand, so instead of 24,000 being the taxable income, it's going to be, so it's
14,000.
14,000.
14,000 and
So let,
minus your interest,
yeah,
property tax,
okay.
everything else is, and then your expenses, probably your property
Yeah.
management
So,
expenses.
so that's why you said you might even not have to pay at the end
Right.
because you're taking that 10,000 just like that.
Yeah.
You might,
It's almost, it's gone. Half of them is gone right there.
oh, I'll do that. I mean, I'm
Yeah.
definitely.
Yeah, that's with that is with the residential property, guys. So if you have a commercial property, you have 39 years.
Wow.
So
Okay.
to do that, take that property value, the building value, divide that by 39, and then that much, like let's say $390,000, right?
Mhm.
Your building value. So you're going to take $10,000 every year
This is
uh,
fantastic
on
news
that.
for every real estate investor. Or actually, we talked a little bit about depreciation in one of our previous episodes about if you're having a vehicle that you're using for your
Not
business.
only vehicle, like asset, any kind of assets other than real estate or land, because
Mhm.
real estate they have a depreciation. You have a 27 and a half year, a
Right,
39-year depreciation. That's separate. And you
right.
have a section 179 for like you said, vehicle, including vehicle, but bigger assets like anything like a bus, a van. You want to
Anything
buy a
above
van
six
and
thousand
rent it out.
pounds, right? Anything weighs more than 6,000
Yeah,
pounds.
6,000 pound, right? So good example is like you can buy like a Mercedes van, right? Like you probably seen it,
Right, yeah.
and then just use it, or maybe rent it out or something. Like
Yeah,
use it for your commercial purposes, and that's going to be qualified, guys. So you could actually take advantage of that. It's bigger
fantastic.
than 6,000 pounds.
So if you're still with us, and if you're someone like me, who's a little bit anxious to hear the word depreciation and kind of get scared all this time, the moment you hear the word depreciation, don't be anymore, because you can actually use that to your advantage, for your advantage, when you're filing taxes, and it's actually they're giving you that 10 grand just like that.
Yeah,
Use it.
yeah,
um
that's right, guys. Don't lose it.
yeah, don't lose it. You snooze, you lose, right? So
Yeah.
don't do that, and use that to for advantage. And when you're filing taxes, and if you haven't heard any of this before, I'm glad that we shared this information with you today, so you can make use of this fantastic opportunity that actually served you on a platter. Why not make the maximum use of it, right? Thank you so
That's
much.
right. I just wanted to add one thing. Like when you're writing down for your CPA and your notebook, like what are the things to be asking
Asking, yeah.
him or her,
Yeah.
write down this depreciation too. Bonus depreciation, section 179, real estate depreciation, write down
Yes.
all those things.
And there's no specific word for that, right? You just say real estate depreciation advantage.
27 and a half years, like, if you, at least sometime you have to remind the CPA if the
Yes.
CPA
I mean,
doesn't do these
he's
kind of
also a
things.
human being, right? He might not remember everything. So
Right.
just make sure that you refresh their memory, and it's great for your knowledge sharing things too. So again, thank you so much. If you're still with us, thank you so much, guys. If you like the video, hit the like button, share the good word. I mean, this is about knowledge share, and we would like to hear what you think about our videos, and what if you want anything that you want us to discuss, please let us know. That's how it has to be a two-way thing, and we will
Right.
love to share the information. Thank you so much,
That's
guys.
right, guys. Thank you.